This problem is rather complex, but it isn't that difficult if we go ahead and we lay it out with a very intentional and formal structure that follows a process that allows us to use the concept of the dividend discount model, which is our primary cash flow model for determining what a stock's price should be, but we use it in conjunction with what we call the Gordon constant growth model so that we can guess what a stock price might be at a particular time when we don't know all the cash flows, but we presume that things will happen normally and constantly over time. So the way that I'm attempting to assist you in constructing the answer for this problem is to lay it out in a very orderly fashion where the first thing we'll do is read through the problem and document all our assumptions. The assumptions then we will use in order to be able to project whether or not GIA will be profitable as measured by the income statement over time for 5 years. Once we determine whether or not she's profitable, then we can estimate what profit sharing or dividends investors would be able to receive if GIA's business actually made a profit that could be shared with them. Then we can jump into the future and say, all right, if she continued on this path, let's guess how much a stock would sell for in the future so that we as investors could estimate the future price that it could grow to. Then, putting it all together, we'll combine the outcome that we get from the Gordon constant growth model with the dividend discount model to try to estimate the price that GIA could sell for a share of stock today. I might suggest that in the spirit of simplicity, you pause the video at some point and you take a look at how I've laid out my spreadsheet. Notice that when we document assumptions, the first thing we did was lay out 5 years and then said, our job here is going to be to make assumptions about the income statement, which will include revenues and expenses. And then there's some additional information that I need to understand, like shares, how she's going to pay out her investors, that constant growth rate, and then the opportunity cost of capital. So I can project out an income statement. Once I've got an income statement projected out, then I can estimate what dividends she'll be able to pay. And then from there, down at the bottom, we'll be able to put that together into the dividend discount model that will allow us to estimate future price. So think about pausing and look through that layout so that you can see what the process is. So let me lay it out for you together. So first thing I'm going to do is freeze panes so that we can look at what some of these assumptions are and how to document it. So first thing I saw was there are 5 years, and now I want to look at how GIA is actually going to make money. So it looks like she's going to sell tacos. And from microeconomics, you learn that price and quantity is total revenues. So let's key in the 12,000, the 15,500, the 19,000, the 22,500, and the 26,000 tacos she plans to sell. All of them then are going to be sold at $2.50, which would be the price of her tacos. So we document those assumptions so that in here we understand her revenue stream. But in order to generate revenues, we need to take on a certain amount of expenses. In the problem, it suggests that the meat and the lettuce and the sour cream and things, which we would call cost of goods, will account for 55% of sales. So that if you sold a given taco at $2.50, what that suggests to me is $1.38 would go into the ingredients. Whereas all the correlated costs, SG&A, insurance, and marketing and whatnot, would be 14 cents. So that, for example, a $2.50 taco would suggest that we spend 35 cents on those corresponding costs. Now, GIA is going to have to get a truck. That truck will depreciate, so we'll document that she's going to depreciate her truck at $7,000 per year. There will be no interest paid, which is a good thing for now. So we'll go ahead and indicate there's 0 interest. However, she is going to pay taxes of 35% on all of her earnings. So we'll document that as well. And now we have all the basics down from where we've begun for an income statement, revenues and expenses, so that we can see whether or not she's going to be profitable. Additionally, we need to know she is thinking about issuing shares, and the amount of shares that she's thinking about issuing, if we look back at the top, was 1,500. So she had 1,500 in shares that she's going to offer for investors. And then plowback and payout. In the formulas, it's required to know that first Gia has to be profitable. Once she's profitable, she can pay out a portion of her profits. The portion of the profits that she is going to pay out would be 30%. By definition, and something we'll use later then, that means that she will keep all of the remainder of her profits to be used for reinvestment. So if, for example, she makes $1 in profit, 30 cents of it we would get as an investor, and 70 cents she would keep to go into possibly doing something like buying a new truck in the future to expand. Now, this is her operating experience for the next 5 years. But at some point, we don't know what she's going to do in years 6 through 50. So we just make a guess that starting in the 5th year, then, her constant growth will be 10%. Ultimately, we know, though, that one of the things we've always thought about is opportunity cost of capital, which in the problem suggests the thing that we could do otherwise would invest in something else and earn a rate of return of 17%. We can go quickly in projecting out her income statement, and a reminder, you can pause at any given point in time and go back and look. So from microeconomics, what's revenues? Price times quantity tells me that in the first year she would make $30,000 in revenues, and then ultimately in the last year, selling $2.50 tacos and selling 26,000 of them, she'd make $65,000. How does she make those tacos? First, she has to put ingredients. Cost of goods sold is going to be a percent of sales. So if she sells $30,000 worth of tacos and the ingredients require a 55% expense rate, that tells me that of the $30,000 in sales, $16,500 will be spent on ingredients. Projecting that out and using our basic copy and paste, we would see that, for example, in the last year, 55% of her $65,000 in sales would give us $35,750. Gross profit, we know, is equal to revenues minus cost of goods sold, so we can go ahead and copy and paste that across. SG&A, it too, as indicated in the problem, will be, and, oops, that's not and, where's the and A will also be as a percent of sales. So if we take that same approach that we took up above, for the $30,000 in tacos she sells, 14% of that will be consumed in rent and marketing and etc. And so we can project out the amount of our SG&A. EBITDA is equal to gross profit minus SG&A, and that tells us the amount of earnings before her interest, tax, and depreciation. When we get to depreciation, since we made a good documentation of it above, we can just equals point and enter, and we get that we have $7,000 a year for which her truck will be depreciated, which tells us then that, pardon my quick movements around there, that her EBIT will be EBIT minus depreciation, from which we documented that she'll pay no interest, so that the amount of profit before tax that she'll make is equal to EBIT minus that interest, to which then EBT, earnings before tax, we apply tax. So if she was to make $2,300, the problem suggests that what she's going to have to pay is 35% in taxes. So there are our tax liabilities, so that we can answer the question, hey Gia, is your taco truck profitable? The answer is, for years 1 through 5, here are the estimated profits that she would make. Now, how do you pay dividends then? In order to be able to pay a dividend, the theory says that the first thing you must do is be profitable to make more money selling tacos than it costs you to produce them. Once you are profitable, then you can pay out dividends. Think of that as basic profit sharing. Anything else that you don't pay out, you keep so that you can invest it in potentially expansion, like a new truck. So if she makes $1,495 as profit, but she gives out 30% of that as her payout rate, that means that she would go ahead and pay out $448.50. Up above, I'm going to make a quick change. I noticed there's an error here. If you pay out 30 cents, the only thing you can do is to keep the rest of it. So the way that plowback works, for every $1 you make, if you pay out a certain percentage of it, the only thing you can do with the remainder is keep it. So that plowback is equal to 1 minus your payout rate. These are formulas you probably want to document on a formula sheet and are welcome to bring in with you to an exam. All right, so back to dividends. How about year 2? If she makes $32.58 and she pays out in total 30% of that to all of her investors, she would pay out $977.44, and etc. until the end, where she would have the ability to distribute $25.64 to her investors. But this is the total amount of dividends. I may be one investor of 1,500 in total, so I have to share the profits with 1,499 other people. So how much would each of them get on a per share basis? Well, the $448.50 would have to be profits that are divided amongst all of us shareholders. So each of us would get 30 cents in that first year, up until the end, where I would get $1.71. That $25.64 that we would share with all of our other investors would yield me $1.71. Now that I can start thinking about, why would I make an investment in a taco truck? Well, the reason is because I, as an investor, want to get paid back. So dividends are a portion of my payback. And I'm thinking about how those dividends would work for me for the first 5 years. So we would think about it as, how much would I be willing to pay for those dividends? So the cash flows that I would get in would start with my dividend payment. So in the first year I'd get 30 cents, and in the second year I'd get 65 cents, and in the third year I'd get $1, and etc. until I could estimate for the first 5 years in total I would receive $5.30 in the first year through $1.71 in the fifth year. But what if I didn't want to invest in her forever, and eventually, in the end of year 5, I wanted to sell that? Well, I don't know how Gia's going to do for all of these years into the future. So instead, what we can use is what's called the Gordon Constant Growth Model. And what the Gordon Constant Growth Model suggests is that the way that you calculate the price of a stock at some point, when you can make the assumption that the world is going to be normal and things will be the same, is the price in that year will be equal to the next dividend that an investor would get divided by rate minus growth. So let's execute this formula into the cell that tells me, as an investor, here's how much I think I could get in the future. So what would the investor get who buys in year 5? Well, they would get the $1.71, but that they think will grow constantly by 10%. So if I take my $1.71 and I grow it by 10%, the investor who buys from me would expect in the next period, year 6, if they were to buy in year 5, they get $1.88. But they would expect that to grow constantly. The formula says, in order to be able to do that, we take that next dividend, give 1, which would be the 6th year dividend since I'm in year 5, and divide it by rate minus growth.